For today's video, we're going to answer a question that comes up actually a lot at this time of year. Is it possible to be approved for a mortgage based on the terms of a new job? And this new job is not scheduled to start until after you want to close on the purchase mortgage transaction. Is it possible? If it is possible, what are the rules, the considerations, the constraints involved, etc.? And while answering this question, I also wanted to demonstrate something that I think a lot of people don't know about. The main conventional mortgage agencies, Fannie Mae, Freddie Mac, both have their entire lending guideline manual available online. Anybody can access it. You don't need a username, a password. There's no paywall or anything like that. All this information is freely available. And I'm going to show you by answering this question how to navigate some of your own questions, going directly to the source. First step, go to your favorite internet.com portal, and we're going to search Fannie Mae Selling Guide, PDF. The reason you want to search for the PDF is the main website will try to lead you through kind of these little subsections. It ends up being incredibly difficult to navigate. So what I like doing is getting the entire PDF in front of me. That way I can scroll through it very easily. What comes up is a massive document. This is well over 1,000 pages here. We'll just take a quick scroll through. It is just massive. Let's see, how many pages do we got here? 1,222. So a document of this scale, combined with the fact that most of the terminology is, for an audience of people that are actually in the mortgage business, I don't want the size of the document or the kind of inside baseball terminology to throw you off from the power of being able to access this guideline manual. So what we're going to do to start with, I like to start with the table of contents first and then fall back on the search function in case I need to. Now, table of contents is divided into a million different sections and subsections. Part A here, we'll see this is doing business with Fannie Mae. As you might imagine from the title, this has much more to do with the inner workings of the originating lender, their relationship with the agency. So what we're looking for is not going to be in that section. We're just going to scroll on through. Part B, however, this is origination through closing. So this is the big section that's going to have the information that we're looking for. The question is where? Loan application package, eligibility. I want to find income because this employment, because this is almost certainly going to be addressed in that section. Okay, income assessment. Let's go ahead and click on that to carry us through. We have a few subsections here. Employment and other sources, self-employed, blah, blah, blah. Scroll down here. Other sources of income. I'm going to go ahead and click that. All right, other sources of income. We have this big list right here. And what do you know? Employment offers or contracts. That's the section that's going to answer our question for us. They're presenting us with two different options. If the borrower is scheduled to begin employment under the terms of an employment offer or contract, the lender may deliver the loan in accordance with one of the options below. Option 1, pay stub obtained before loan delivery. Now, the question as I've phrased it kind of assumes that you're not going to necessarily have a pay stub by the time that you close. But you'll notice the term here, loan delivery. You might assume that loan delivery is the same as the closing, but what loan delivery actually refers to is when the lender sends the loan off to be purchased by Fannie Mae. It's typically going to occur shortly after the closing date, but it's not the same as the closing date. So this option 1 is not really going to be relevant to what we are looking for. I'm going to scroll back to that in case we need to. Option 2, pay stub not obtained before loan delivery. That's what we want. Number 1, this option is limited to loans that meet the following criteria. It's got to be a purchase transaction. This needs to be a principal or primary residence. It's got to be a one-unit property. So if you are planning to purchase a duplex as your primary residence and you're trying to get in there under this scenario that we've established, that wouldn't work because in option 2 here, it says it's only for a one-unit property. Now, the next best option would maybe be this option 1. If you can line up your closing date and the start of your job just right, where you can get a pay stub before the lender has to deliver that loan on to Fannie, you may be able to qualify under the much less restrictive guidelines here under option 1, which would be the lender has to obtain an executed copy of the borrower's offer or contract for future employment and anticipated income. 2, prior to delivering the loan, the lender must obtain a pay stub from the borrower that includes sufficient information to support the income used to qualify the borrower, etc. So this is something that would require really a conversation between you and the lender, whether that's me or somebody else, because there may be a way to make that whole loan delivery date work depending on the timing of when you get that pay stub. So let's move on under option 2. Next up, the borrower is not employed by a family member or by an interested party to the transaction. One of the things to understand about Fannie Mae is that these guidelines are established for a lot of different reasons. But one of the main things that they are concerned about is anything that maybe has a higher incidence of fraud. And unfortunately, Fannie Mae is coming to the conclusion that if it's a family member signing off on your employment contract, it kind of makes sense that the chances that maybe there's something fraudulent going on are higher in that instance, rather than if you have an employment contract by a disinterested kind of third-party employer that's decided to hire you. And likewise, you're not allowed to be employed by an interested party to the transaction. Therefore, if the seller of the property is the new employer, maybe that looks a little fishy. Fannie Mae is just saying they don't want to have anything to do with it. Next up, the borrower is qualified using only fixed base income. Now, this comes up a lot if I've got people that are in the sales world. They're maybe landing a new sales job, and that job is maybe 90% commission, 10% base salary. Under that instance, if we don't have a pay stub prior to when we deliver the loan to Fannie, we would have to qualify that borrower solely off of the fixed portion of that income. The lender must obtain and review the borrower's offer or contract for future employment. The employment offer or contract must clearly identify the employer and the borrower, be signed by the employer, and be accepted and signed by the borrower. Clearly identify the terms of employment, including position, type, and rate of pay, and start date. And finally, it must be non-contingent. If conditions of employment exist, the lender must confirm prior to closing that all conditions of employment are satisfied, either by verbal verification or written documentation. Now, what they're really saying in this section, where this comes up a lot with my physician clients. Maybe somebody is getting out of residency and they're taking their first kind of post-training position at a hospital or private practice somewhere. Most of the time, those employment offers are put together well in advance of the start date on that job. And one of the most common contingencies that's going to be on those letters is it's going to say, okay, you're moving from, Oklahoma to Kansas, or you're moving from wherever to wherever, whatever state the new job is in. You have to obtain the appropriate state licensure before you can actually start on the job. So that contingency, we could maybe start the process with the contingency in place, but everyone would have to be aware that we have to verify prior to closing that contingency has been resolved, your licensure has come through, or whatever contingency there is has been resolved prior to the close. Okay, next up, the borrower's start date must be no earlier than 30 days prior to the note date, or no later than 90 days after the note date. Now, in this first part, the language, and you're going to find this all over this manual, the language is kind of clunky. And sometimes it's a little bit difficult to parse. So just kind of slow down and piece it together would be my advice. The first part here, the borrower's start date must not be earlier than 30 days prior to the note date. Well, really all they're referring to there is that you don't really need this subsection to get mortgage approval if you're starting your job that well in advance of the note date, which is one and the same as the closing date. In that instance, they're essentially saying, in a way that I think they could actually make much more explicit, what they're saying is that you need to not even be in this section of the manual. You need to go elsewhere in the manual, because that kind of timeline, you're typically going to have a pay stub in place. They're just saying that this doesn't really apply to that instance. Now, what I'm more interested in here is the no later than 90 days after the note date. What this means, and this guideline is a great example of one that's actually gotten a lot looser over time. You could close 90 days before you start a new job under this guideline. That gives you a lot of flexibility. And in the past, it's either been impossible to do this, or it's been a much lower time frame between the time that you close and when you start that job. So this is a very good guideline, offers a lot of flexibility. All right, and then we've got the manual loves these little bracket sections. If the borrower's start date is the note date or no more than 30 days prior to the note date, the documentation required is employment offer or contract and verbal verification of employment that confirms active employment status. If it's no more than 90 days after the note date, we just need the employment offer or contract. All right, and the rules continue on to the next page. We're still under this option 2. As you can see, it would be really nice if we could get that pay stub in before we deliver that loan to Fannie, because there's not much to the restrictions involved. This option 2 is, there's a lot that we have to comply with and a lot that we have to plan for to make sure we don't run into trouble. So the guidelines go on to say the lender must document, in addition to the amount of reserves required by DU or for the transaction, one of the following. Quick pause. DU refers to Fannie Mae's version of something called an automated underwriting system. Now, ultimately, what I am saying here is that you have access to a lot of good information. I'm not telling you that this is a total DIY. You can do your loan yourself. A lender will still have to run your file through all the appropriate processes, and one of those is running it through this automated underwriting system. Now, what they're saying here is that the automated system, based on the strengths or weaknesses of your loan file, may indicate that they want you to have some money left over in reserve in addition to the down payment that we're documenting, that you may need some money left over in reserve in order to qualify. So they go on to say, financial reserve sufficient to cover principal, interest, taxes, insurance, and association dues. This is a great acronym, PITIA, for the subject property for 6 months. So what they're saying in this case is that in addition to whatever reserves DU is requiring, just based on your loan file without regard to this special case, they're saying that you need an additional 6 months of total mortgage payments and obligations on the property. You're going to need to be able to document that amount of money in addition to the amount that you need for your down payment and your closing costs. All right, now we have an or here, which is nice. So let's say maybe we don't have 6 months of reserves left over. What's our other option? This is going to be a little bit complicated. Financial resources sufficient to cover the monthly liabilities included in the debt to income ratio, including the new full mortgage payment for the property that's being purchased, for the number of months between the note date, which is the same as the closing date, and the employment start date plus 1. Now, I'm just going to kind of summarize the remainder of this. I'm not going to make you sit and watch me read through the rest of this. What they're saying here is that if you don't have 6 months of assets just left over, 6 months of payments left over in assets on top of what you need for down payment and closing costs, they're saying essentially if you're still on the job somewhere, although we're using that new job to qualify you on this loan, a combination of the amount you do have in reserves and the income that you're going to continue to get on the new job, they can use that to, in theory, get around the full 6 months requirement. That's the answer to the question. The short answer to the question is yes. Even if you're starting a job after you plan to close on a purchase transaction, we can use and we can qualify you based on the new income for that new job. But it's subject to a lot of rules. And that is what you rely on a good loan officer to help you with. Again, I'm answering this question here, but I'm also trying to demonstrate to some degree the complexity of the process behind the scenes. You need to partner with a loan officer that is very conversant with these guidelines, that is very able to interpret the guidelines. So when they're looking at your file on the front end and trying to give you some assurance about what's going to happen in terms of whether or not you're going to be approved by the underwriter, etc., you really need somebody that knows what they're looking at here. But it's also cool, I think, that you as somebody not in the business can just go straight to the source. And whatever question it is, you can find answers. So I hope that was helpful and interesting. Thank you so much for watching the video. I hope to talk to you again soon.